Welcome to today's webinar, presented by JenniferLangFinancialServices.com, specializing in annuities, 401k rollovers and safe no-market risk retirement planning. Understanding tax strategies and managing your tax bill are an integral part of a sound financial approach. Conversely, ignoring the tax ramifications of your investment portfolio may result in lower overall performance. Some taxes can be deferred, and others can be managed through tax-efficient investing. With a careful and consistent preparation, you can potentially reduce the impact of taxes on your overall investment returns. We would like to thank everyone for attending today. This presentation is being recorded and will be available for rebroadcast later on. So please submit all questions via our website, JenniferLangFinancialServices.com. Today's presentation is entitled, Tax Management Strategies, and as a token of our appreciation, everyone on the webinar today will be given access to a free ebook that you can download after the call. So, let's jump in. JenniferLangFinancialServices.com is dedicated to helping individuals evaluate their financial situations. We want to provide people with tools that can help them make informed decisions. We offer informational material on a wide range of topics because we understand that individuals have diverse financial needs. If you have any questions or concerns during the course of this presentation, we invite you to take advantage of our complimentary consultation. During the consultation, we can discuss your questions and begin the process of helping you develop a financial approach that will address your individual needs. Keep in mind that the information in this material is not intended as tax or legal advice. It may not be used for the purpose of avoiding any federal tax penalties. Please consult a professional for specific information regarding your individual situation. The enactment of the Tax Cuts and Jobs Act represents the most sweeping overhaul of the U.S. tax code in more than 30 years. For millions of Americans and businesses, it means an altered financial and investment landscape with new opportunities and challenges in the years ahead. Keep in mind, however, that the information in this material is not intended as tax advice, and may not be used for the purpose of avoiding any federal tax penalties. Here are just a few of the highlights. Businesses may begin benefiting from a number of changes, including a lowered business tax rate from 35% to 21%. The Tax Policy Center projects that taxes will fall for all income groups and result in an increase of 2.2% in after-tax income. Among other items, the Tax Cut and Jobs Act repealed the alternative minimum tax and placed a $10,000 cap on state and local income tax deductions. Keep in mind that for most individual taxpayers, these changes kicked in when they filed their 2018 taxes, and some are scheduled to expire in 2025. The wealthiest 20% of U.S. taxpayers pay nearly 87% of all income taxes. Take a moment and consider that statistic. 20% of the people pay 87% of all federal income tax. How wealthy do you have to be to get in the top 20%? To qualify, a household has to have an adjusted gross income of more than about $112,000. On the other side of the equation, the bottom 80% of all taxpayers pay about 13% of all federal income taxes. The bottom 20% actually have a negative tax rate. That means they get more money back from Uncle Sam in the form of refundable tax credits than they pay in taxes. American households face many types of taxes. We all know about federal income taxes. The federal government also levies Social Security and Medicare, which are normally taken out of each paycheck, as well as gift and estate taxes. Then states jump in with state income taxes, sales taxes, and excise taxes on gasoline, tobacco, alcohol, and other products. In addition, local governments take their share in property taxes and sales taxes. Altogether, taxes can be a large burden. So it makes sense to try to manage every dollar in taxes that you can. It's not necessary to have a comprehensive understanding of the tax code, and the thousands of pages of federal tax regulations that back them up. But to manage the impact of taxes, it's critical to understand certain principles. A study by Morningstar showed that during the 92-year period ending in 2017, the average annual stock return of 10.2% shrank to 8.2% after taxes. Morningstar's research was compiled to illustrate the potential impact of taxes on investment performance. Now, past performance does not guarantee future results. This is a hypothetical example used for illustrative purposes only. It is not representative of any specific investment or combination of investments. In this graphic, stocks are represented by the Ibbotson Large Company Stock Index. Individuals cannot invest directly in an index. Morningstar calculated the federal income tax by using the historical marginal and capital gains tax rates for a single taxpayer earning $120,000 in 2015 every year. Annual income was adjusted each year using the Consumer Price Index, better known as CPI, which is considered representative of overall U.S. prices at the consumer level. CPI adjustments were used to adjust the income level for each year. Income was taxed at the appropriate federal tax rate when it was taken. When realized, capital gains were calculated using the appropriate capital gains rate. For stock prices, the holding period for capital gains tax calculation is assumed to be 5 years. No state taxes were included in the calculation. There's an old joke that the difference between death and taxes is that death doesn't get any worse whenever Congress goes into session. As administrations come and go, the tax rules change. Since 1940, there have been 81 major changes in tax legislation. The illustration shows the cumulative number of major changes to tax legislation. Each time the tax rules change, your investment portfolio may be affected. It is critical to stay current with changes in legislation that may affect your tax liability. Tax-favored investing involves both tax-exempt investments and tax-deferred investments. Municipal bonds are free of federal income tax and may be free of state and local income taxes for investors who live in the area where the bond was issued. Tax-deferred investments, on which taxes are postponed until you withdraw your money, include qualified retirement plans, such as traditional IRAs and employer-sponsored plans, as well as insurance products like annuities and sometimes indexed universal life insurance policies. Money held in money market funds is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Money market funds are investment funds that seek to preserve the value of your investment at $1 a share. However, it is possible to lose money by investing in a money market fund. Mutual funds are sold only by prospectus. Please consider the charges, risks, expenses, and investment objectives carefully before investing. A prospectus containing this and other information about the investment company can be obtained from your financial professional. Read it carefully before you invest or send money. Annuities have contract limitations, fees, and charges, including account and administrative fees, underlying investment management fees, mortality and expense fees, and charges for optional benefits. Most annuities have surrender fees that are usually highest if you take out the money in the initial years of the annuity contract. Several factors will affect the cost and availability of life insurance, including age, health, and the type and amount of insurance purchased. Life insurance policies have expenses, including mortality and other charges. The following video summarizes the power of tax-deferred growth.
Deferring taxes can be a powerful investment decision. The dollars that would have gone to paying taxes remain in your account, which means more money working for potential returns. Here's how it works. Say you invest $10,000 a year in a taxable account earning 6%, and your tax rate is 25%. After 20 years, your account would be worth nearly $330,000. A tidy sum, but that same money put in a tax-deferred account would be worth nearly $390,000, $60,000 more. That's one of the reasons why 401k plans are so popular. Combining tax-free contributions with tax-deferred growth can be a sound long-term strategy. Other accounts also let you delay paying taxes. Individual retirement accounts, or IRAs, allow money to accumulate tax-deferred. Wealthy investors see the benefits of traditional IRAs. At last check, 72% of households with annual incomes of $200,000 or more have at least one IRA. Roth IRAs don't offer tax-free contributions, but they do offer tax-free growth and tax-free withdrawals. Created in 1988, their popularity has been increasing. In fact, nearly 20% of households own a Roth IRA. Annuity contracts, which trace their origins back to Roman times, also offer tax-deferred growth, and contributions are made with after-tax dollars. There are many different types of annuity contracts. A review of your unique situation would help determine if one is suitable. Put the power of tax deferral to work for you. Call today so we can review your retirement strategy.
The municipal bond market is a huge market. Recent estimates put the market for municipal bonds at $3.9 trillion. Municipal bonds are the way state and local governments and government agencies borrow money to finance their operations. Here is how they work. A state or local government borrows a set amount of money, then pays interest on that money. This interest may be free of federal income taxes. If the bond was issued within the state where the investor lives, the interest may be free from state and local taxes as well. Bear in mind that while the interest from a municipal bond is tax-free, any capital gains will be subject to taxes. And the alternative minimum tax may apply. Bond prices rise and fall daily. Municipal bonds are subject to a variety of risks, including adjustments in interest rates, call risk, market conditions, and default risk. When interest rates rise, bond prices generally will fall. Certain municipal bonds may be difficult to sell. A municipal bond issuer may be unable to make interest or principal payments, which may lead to the issuer defaulting on the bond. If this occurs, the municipal bond may have little or no value. If a bond is purchased at a premium, it may result in realized losses. It's possible that the interest on a municipal bond may be determined to be taxable after purchase. If generating income is a priority for you, and if you are in a high-income bracket, a tax-free municipal bond can offer advantages. Individual bonds are self-directed and have no annual cost. Bond funds, on the other hand, offer greater diversity and liquidity for the investor, and may help manage risk. A municipal bond fund may be appropriate for investors with a need for tax-free income. Keep in mind, however, that diversification is an approach to help manage investment risk. It does not eliminate the risk of loss if security prices decline. A bond fund's net asset value, NAV, will fluctuate with the price of the underlying bonds in the portfolio. The NAV also may fluctuate as a result of turnover activity. Bond fund shares may lose principal during a period of rising interest rates. Return of principal is not guaranteed. Investing in mutual funds is subject to risk and potential loss of principal. There is no assurance or certainty that any investment or strategy will be successful in meeting its objectives. Investors should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The prospectus contains this and other information about the funds. Contact the fund company directly or your financial professional to obtain a prospectus, which should be read carefully before investing or sending money. Any fair comparison between a tax-exempt investment and a taxable investment needs to factor in the cost of paying the taxes on the taxable investment. And that comparison will differ for investors in different marginal income tax brackets. Let's look at one example. Consider an investor in the 32% marginal income tax bracket who is considering a tax-exempt investment that has a 6% yield. What is her real rate of return? This table charts the equivalent yield for tax-exempt and taxable investments. According to the chart, our investor would find that a tax-exempt yield of 6% would be the equivalent of a taxable yield of nearly 9%. That is, she would have to find a taxable investment with a 9% yield to end up with the same return as the 6% return on a tax-exempt investment. This table is a hypothetical example used for comparison purposes and is not intended to represent the past or future performance of any investment. Actual returns will fluctuate. State taxes, capital gains taxes, and alternative minimum taxes were not considered in this example. The taxable equivalent yield is only one factor that should be considered when purchasing securities. The table should be used as general guideline. Rates of return will vary over time. Actual results will fluctuate. The other category of tax-advantaged investments is tax-deferred investments. That is, investments on which taxes are postponed until withdrawn. Chief among these are qualified retirement plans, most commonly 401k plans, 403(b) plans, and traditional IRAs. Within certain limits, these qualified retirement plans allow investors to make pre-tax contributions, that is, contributions are deducted from income before income taxes are calculated. Investments accumulate tax-deferred, leaving more money in the account and putting more money toward potential returns. Investment earnings are taxed when they are taken out of the plan. And, if withdrawals are made before age 59 and a half, they may be subject to a 10% federal income tax penalty. For people currently at their maximum earning power, investing in tax-deferred vehicles can offer a real savings on the tax bill. It should also be remembered that there is a limit to the employee compensation that may be used to calculate contributions to, or benefits provided by the plan. In 2020, that compensation limit was $285,000. When broken down, the advantages of qualified retirement plans can be significant. In this example, $1,000 is contributed to a 401k plan. The contribution is made with pre-tax dollars, which has the potential to add up over time. For example, say an investor was in the 24% tax bracket. That person would have to save $1,316 to contribute the same $1,000 in another type of savings account. A further benefit is enjoyed where an employer offers to match contributions. It's important to understand that distributions from 401k plans and most other employer-sponsored retirement plans are taxed as ordinary income and, if taken before age 59.5, may be subject to a 10% federal income tax penalty. Generally, once you reach age 72, you must begin taking required minimum distributions. This is a hypothetical example used for illustrative purposes only and is not intended to represent the past or future performance of any investment. Actual returns will fluctuate. When saving for retirement, an investor should consider taking advantage of every tax-advantaged vehicle possible in an attempt to maximize the potential return on investment. Contributing as much as possible to an employer-sponsored plan is an important part of the strategy. These plans often offer employer-matching contributions, effectively providing an instant return in addition to the tax-deferred return on the account. Distributions from 401k plans and most other employer-sponsored retirement plans are taxed as ordinary income and, if taken before age 59.5, may be subject to a 10% federal income tax penalty. Generally, once you reach age 72, you must begin taking required minimum distributions. It also may be important to consider contributing to an IRA. Contributions to a traditional IRA may be fully or partially deductible, depending on your individual circumstance. Distributions from traditional IRAs and most other employer-sponsored retirement plans are taxed as ordinary income and, if taken before age 59.5, may be subject to a 10% federal income tax penalty. Contributions to a Roth IRA aren't deductible, but withdrawals are free from taxes. However, Roth IRA contributions cannot be made by taxpayers with high incomes. To qualify for the tax-free and penalty-free withdrawal of earnings, Roth IRA distributions must meet a 5-year holding requirement and occur after age 59.5. Another tax-deferred option is an annuity. An annuity is basically a contract with an insurance company. You pay a certain amount, and in return, the insurance company pays you according to a predetermined schedule. There are two basic types of annuities, deferred and immediate. Deferred annuities are set up for long-term accumulation. When purchased, individuals may expect their money to grow tax-deferred and provide an income stream when they reach their retirement years. The premiums paid accumulate and earn interest during the accumulation phase. The money accumulates tax-deferred, and is not taxed until it is withdrawn. Conversely, immediate annuities are designed to provide income right away. Individuals who buy an immediate annuity are looking for a steady, consistent income stream generated over a number of years. Once the premium is paid, an individual is entitled to receive regular income that is guaranteed by the issuing insurance company. Annuities have contract limitations, fees, and charges, including account and administrative fees, underlying investment management fees, mortality and expense fees, and charges for optional benefits. Most annuities have surrender fees that are usually highest if you take out the money in the initial years of the annuity contract. Withdrawals and income payments are taxed as ordinary income. There are ways to combine these tax-saving tools creatively and effectively. One strategy combines different types of annuities to generate income and rebuild principal at the same time, and in a very tax-efficient manner. Here's how it works. An investor divides $100,000 between a fixed-period immediate annuity and a single premium deferred annuity. Assuming a 3% return and a 10-year contract, the immediate annuity would immediately start paying $250 a month in income. During the same time, the funds in the deferred annuity, also assuming a 3% return, would grow to $100,000, effectively replacing the principal. At the end of the period, the investor can start the process over with the funds from the deferred annuity. The earnings component of an annuity withdrawal is taxed as ordinary income and, if taken before age 59.5, may be subject to a 10% federal income tax penalty. The guarantees of an annuity contract depend on the issuing company's claims-paying ability. Annuities have fees and charges associated with the contract, and a surrender charge also may apply if the contract owner elects to give up the annuity before certain time period conditions are satisfied. The following video looks at hypothetical friends Owen and Clara, and demonstrates how two potential strategies for retirement income compare in the face of market losses, longevity, inflation, and low rates. Whose strategy is more efficient for reducing the pressure on their portfolio to help meet their financial objectives? Watch the video to find out.
Question: how can I take some pressure off my retirement portfolio? Allianz answers. Does the prospect of saving for retirement seem more daunting than ever? You may be concerned with market losses, the risk of outliving your money, and inflation. If you're trying to preserve your portfolio in an era of low rates and increased volatility, there's also the question of how you'll generate predictable, sustainable, and potentially increasing income, and that's only half of it. Compared to previous generations of retirees, your retirement strategy will need to rely more heavily on your personal assets to achieve your objectives. It all adds up to a lot of pressure on your portfolio. You may be thinking,
sure, there are risks, but how significant are they?
Consider this. Too much pressure on your portfolio can lead to depleting it and running out of money sooner than you expected. So much for living comfortably in retirement. The difference between a more secure future and a more uncertain one could be the success of your retirement income strategy. Our hypothetical friends, Owen and Clara, are here to show us why. They're the same age, they're each starting with $750,000 in savings, and both of them want to generate $40,000 in annual income in retirement in 5 years with no more than a 4% withdrawal rate.
While Owen is approaching retirement with his retirement account only, Clara plans to combine her retirement account with a fixed index annuity, or FIA. Let's start with Owen. To reach his goal, he needs to grow his $750,000 savings to $1 million in 5 years. During those 5 years, Owen will continue to grow his retirement account without making additional contributions and without making withdrawals. That will require his savings to produce an average annual return of 5.92% net fees. What are the benefits of Owen's strategy? For starters, he has control, liquidity, and flexibility of his assets, and the potential opportunity for more gains compared to other strategies. Except his assets are unprotected and exposed to risks, like market risk, sequence of returns risk, and the possibility of outliving his money. That means his income isn't guaranteed to last his lifetime either. And as another disadvantage, his account needs to return 5.92% net fees every year. So much for taking some pressure off his retirement portfolio. Let's check in to see how Clara is doing with her combined approach, a retirement account with an FIA.
In case you aren't familiar, an FIA is designed to meet long-term needs for retirement income. Some of the benefits include protection from market losses, tax deferral to help Clara grow her savings faster, the potential for credited interest based on positive changes in an external index, a death benefit to help her leave a legacy, and guaranteed income for life. Now, compared to an approach that uses her retirement account only, an FIA may offer Clara less control, liquidity, and flexibility of her assets for a period of time. This is because FIAs have a surrender charge and a market value adjustment if they are surrendered too early. Also, FIAs may have less growth potential than a sole retirement account has. Certain factors like caps, spreads, and participation rates will limit the amount of indexed interest credited. Clara's needs may change as time goes on, which is why it's important to understand the balance between all available features with any annuity. So, Clara purchases an FIA with $225,000 and continues to invest her remaining $525,000 in her retirement account, which is invested the same as Owen's retirement account and requires the same 4% withdrawal rate. After 5 years of waiting, her fixed index annuity would generate this much guaranteed lifetime income. As a result, she successfully reduces the pressure on her retirement account to generate the balance of income and only requires an average annual return of 2.34% net fees to achieve the same $40,000 in income as Owen. Keep in mind, this assumes no interest is credited to Clara's annuity during the 5-year period. In fact, any FIA interest she earns would take even more pressure off her portfolio, reducing her required average annual return of 2.34%. Clara's combined approach is more efficient than Owen's only retirement account because it requires a lower rate of return to generate the same amount of income and reduces the overall risk of outliving her money as well as withdrawal pressure. Her approach also adds more flexibility and potential for income and growth because a portion of Clara's expenses are covered with guaranteed lifetime income. These factors will help take some pressure off her retirement portfolio in exchange for a level of certainty toward the lifestyle she hopes to sustain.
No one, not even Owen or Clara, can predict how long they'll live or how the market will affect their retirement. That's why it may be important to manage and protect a portion of your portfolio from longevity and market risk with a fixed index annuity to help you maintain the retirement lifestyle you want for as long as you live. Ask your financial professional how a fixed index annuity could help take some pressure off of your retirement portfolio.
Another strategy is to buy an annuity within an IRA. It sounds a bit redundant, doesn't it? Placing a tax-deferred investment like an annuity contract within a tax-deferred account like an IRA sounds like trying to shelter your tax liability twice. For certain people, it may make sense, though. While annuities may have additional costs, they can also offer certain guarantees. Guarantees that aren't available on other investments you might have within an IRA. For example, annuities offer a death benefit for your heirs. And annuities can offer lifetime income. That is, an income stream that cannot be outlived. For these reasons, some people choose to place an annuity in their IRA. Keep in mind that if you are purchasing an annuity to fund any tax-qualified retirement plan such as an IRA, you should be aware that this tax deferral feature is available with any investment vehicle and is not unique to an annuity. Carefully consider the features and benefits of the annuity before making the decision to purchase. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59, the 1st or the 2nd of May, result in a 10% penalty. Another tax-deferred possibility is cash value life insurance. With a cash value life insurance policy, an individual purchases a policy from an insurance company. In exchange for premiums, the insurance company promises to pay a set benefit when the policyholder dies. These life insurance policies also build up cash value, effectively a cash reserve, that pays a modest rate of return. This growth is tax-deferred. Most whole life insurance policies will let policyholders borrow a portion of the policy's cash value under favorable terms. And interest payments on policy loans go directly back into the policy's cash value. This option can be a good one for those who need a secure, steady cash reserve and are happy with a modest rate of return. Several factors will affect the cost and availability of life insurance, including age, health, and the type and amount of insurance purchased. Life insurance policies have expenses, including mortality and other charges. If a policy is surrendered prematurely, the policyholder also may pay surrender charges and have income tax implications. You should consider determining whether you are insurable before implementing a strategy involving life insurance. Any guarantees associated with a policy are dependent on the ability of the issuing insurance company to continue making claim payments. Withdrawals of earnings are fully taxable at ordinary income tax rates. If you are under age 59 and a half when you make the withdrawal, you may be subject to surrender charges and assessed a 10% federal income tax penalty. Also, withdrawals will reduce the benefits and value of the contract. The following video gives an overview of how indexed life insurance policies work.
You take pride in providing for your family and in keeping them safe. It's what families do. Life insurance may already be a part of how you do that. It can ensure that your family is taken care of financially in the event of your death. But what if life insurance could do more than offer protection in the event of your death? Index Universal Life Insurance gives you the opportunity to build cash value within the policy. And it gives you the option of drawing on the death benefit in the event of qualifying chronic, critical, or terminal illness. The policy can earn interest when a market index value increases and will never be credited less than the minimum guaranteed interest rate. When you pay your premiums, after fees and expenses, a portion of the premium pays for life insurance protection. Any amount paid above that is added to the cash value. The cash value may be credited with interest based on changes in a stock market index. The entire cash value can be allocated to a single index account or could be spread among one or more index accounts, depending on the policy. There is typically a maximum rate of interest, known as a cap, and a minimum rate of interest, known as the floor. Both are set by the insurance company and help determine how much interest is credited to a policy. The floor is the minimum guaranteed interest rate that can be credited to the policy. Why is a floor important? As you can see, avoiding loss can be as important as realizing gains. A 40% market loss requires a 67% gain to get back to where it was. A loss of 50% would require a gain of 100% to get even. Here's an example. Let's say the cap is 10% and the floor is 0%. Interest credited can be between the 10% cap and the 0% floor, but will never exceed the 10% cap and will never be less than the 0% floor. As your circumstances change, your life insurance policy can change right along with you, always providing the protection your family needs to go along with the tax-deferred cash value growth potential you want. Ability to increase or decrease the death benefit amount. Flexibility to adjust premium payments. Managing the impact of taxes is an important part of planning for the future. The tax advantages of index universal life insurance include tax advantage access to policy value in the form of loans and partial surrenders, tax deferral on any earnings, tax-free transfers between account options, federal income tax-free death benefit. These tax-deferred earnings may be accessed for future expenses or to supplement retirement income. So if you need a permanent life insurance policy that has a federal income tax-free death benefit, policy value accumulation potential, a way to eliminate negative interest with a floor, and living benefits, index universal life insurance may be a good option.
Deferring the taxes on an account can make a tremendous difference in the rate at which it accumulates. The money that would otherwise have been siphoned off by taxation each year remains in the account, increasing the potential return. If, for example, you were to deposit $100,000 in a taxable investment earning 6%, and assuming you're in the 22% marginal income tax bracket, after 20 years, you'd have accumulated about $250,000. If you'd put the same $100,000 into a tax-deferred account earning the same 6%, you would have ended up with over $320,000. Even after paying taxes, you'd still have over $265,535. That's a difference of more than $30,000. This hypothetical example is used for comparison purposes and is not intended to represent the past or future performance of any investment. No withdrawals were made during the period indicated. Actual returns will fluctuate. The taxable account assumes earnings are taxed as ordinary income. Lower maximum rates on capital gains and dividends would make the taxable account's returns more favorable when compared with the tax-deferred account. The types of securities and strategies illustrated may not be suitable for everyone. Some investments that are free of federal income taxes may be subject to state and local taxes. Also, the alternative minimum tax may apply. Fees and other expenses were not considered in the illustration. Effectively managing your tax liability is a lifelong process. Here are some questions that arise at different stages in life. Anthony and Selena, a two-income couple with school-aged children, ask, how do we take advantage of all available tax credits and deductions? Should we max out our 401k plans? Dave and Christine, a couple nearing retirement, want to know, how do we allocate our assets for the best tax advantages? How can we gift assets to our children in the most tax-effective manner? Rebecca is a single parent and small business owner. She asks, can tax-advantaged investing help me manage my tax burden? What retirement plans are available for small business owners? Isaac likes to do his taxes online, but wonders, am I realizing all of the tax benefits available to me? Are there changes in the tax law that might affect my situation? Answers will depend on each unique situation, and may be found after a professional review. There are a number of strategies you can use to manage income taxes. You need a knowledgeable financial professional in place. And that's where Jennifer Lang Financial Services comes in. We specialize in helping people just like you, make the most of every investment dollar. If you think it may be time to take a closer look at ways to manage your tax liability, schedule a review today. Thank you for joining us today. As a token of our appreciation, you can get your copy of our free 2021 tax planning guide. This free ebook will help you stay prepared for the upcoming tax season. The 2021 edition accounts for changes to the tax code due to the CARES Act and other COVID-19 legislation. You can find it under the ebook section. Simply log on to jenniferlangfinancialservices.com and you'll find it under the ebook section. Don't forget to take advantage of our free complimentary consultation. We specialize in annuities, 401k rollovers and safe, no market risk retirement planning. Thanks again for joining us. Have a great day and stay safe.